This video is intended to briefly summarize the current status quo of Vietnam's economy, in which aspects even Vietnamese people do not realize its seriousness and potential crash. Vietnam's economy is susceptible to collapse due to several key reasons, such as plummeting foreign exchange reserves, abundant quantitative easing, constant devaluation of the dong, large state-owned corporation investment in bureaucratic government operating costs, and tightening monetary policy Resolution 11. Through the end of 2008, Vietnamese foreign exchange reserves stayed as high as $24 billion. In early 2011, Bank of America, which ceased to operate in Vietnam in 2002, closed down its representatives in Ho Chi Minh City or Saigon in early July 2010. The project that the Vietnamese foreign exchange reserve would drop to essentially zero by the second quarter due to mass insufficient investment in state-run corporations, efforts to resist declining value in the dong exchange rate over the dollar, and so on. There are several factors contributing to the decline, such as high inflation consecutively, trade and fiscal deficit, poor government management and performance, and lastly, constant devaluation of the dong, which will be introduced in the next slides. Returning to the U.S. for a moment, in November 2010, the Federal Reserve announced a buyback treasury, essentially bonds, of $60 billion over the course of 7 months. The event basically triggered an underlying QET, or quantitative easing phase 2, for which the Fed issued more U.S. dollars to buy U.S. gross domestic product, was estimated at roughly $14 trillion, out of which $600 billion QET is about 4%. Back to Vietnam. Let's see how the country handled this. By the year 2006, the country's GDP was $48.4 billion. Between 2006 and 2007, the Vietnamese Foreign Exchange Reserve, in short the reserve, increased dramatically from $10 billion to $22 billion at about the pace of 120% a year. Therefore, the central bank pumped at least 12 divided 48.43, equaling nearly 25% of the amount of the dong into the market to acquire $12, including the case of the central bank increased 50% of circulating dong to the market, while the commodity and liquidity remained the same or barely changed at all during this time. Its most substantially damaging move before the government realized that and started tightening monetary policy, but it seemed too late. By circulating too much dong, more than the consuming capacity of the market, the central bank essentially dumped its value over time and elevated the pressure to do a 29-month high and the highest in Asia so far. According to a recent article published on May 16th in the Wall Street Journal, the dong has dropped a fifth of its value since mid-2008, meaning 30% of the dong had depreciated during a 2-year period. In free market, the decline was more of a drama. Regarding state-run corporations and companies, even though they receive preferential treatment from the government in many forms, most of them never make a profit. A few companies are EVN, Petrolimex, Venetian, and so on, and we'll get back to them later. Despite the universally known fact that the government and the ruling party are distinctive in Vietnam, things are slightly different. Let's do another comparison between the U.S. and Vietnam. There are 307 million Americans versus 87 million Vietnamese as of today. The U.S. population is 3.5 times as large as the Vietnamese population. However, the U.S. government, federal, military, and employee numbers were found to be estimated near 17.7 million personnel, according to the 2009 census, and about 5.7% of the population. Now, let's have a look at Vietnamese statistics. Well, it's hard to cite or find any precise numbers since Vietnam has always lacked clarity and transparency. However, according to a saying from the vice chairman of the National Assembly of Vietnam, the number of government employees are about 7 million. The government spends nearly $27,000 billion in salary payments due to rising wages. Assuming each employee receives roughly 2.3 million dong by dividing 27,000 billion, 12 of zero numbers, by 2.3 million dong, we get approximately 11.6 million employees. It is not a scientific way to calculate, but it provides a vision of the number of employees. In conclusion, the number of Vietnamese government employees could be said to range between 7 million and 11 million people, which is about 8% to 12% of the population, compared with 5.7% of the U.S. It gives a prospect of how huge, bureaucratic, and insufficient the Vietnamese government is. Ladies and gentlemen, please welcome the start of the video, Resolution 11. What are the purposes of Resolution 11? Resolution 11 is an attempt by the government to close the gap between official foreign exchange rate and the free market, as well as to increase the foreign exchange reserve by vacuuming foreign currency, predominantly USD, banning free trade to the USD, restricting gold trade, increasing domestic currency, the dong, interest rate, severely curtailing interest rate on the USD, other foreign currencies, and putting an end to gold deposits in the banking system. Of course, there are more measures, but those aforementioned are the most significant ones. Anticipated results of Resolution 11. Shortage of foreign currency, USD, in circulation results in shortage of commodity and skyrocketing inflation. Vietnam has negative trade deficit, mostly in trading with China. Aggressive increasing of foreign exchange rates. Discontinuing of USD inflow to foreign exchange reserve due to depression in the market. Insufficient funds to pay off government-owned companies to foreign creditors. Shortage of foreign currency in circulating, resulting in shortage of commodity and skyrocketing inflation due to the fact that Vietnam's economy heavily relies on exporting raw material and agricultural products, and its main advantage is based on the cheap labor force. Most of the production materials and resources have been imported. Therefore, the bottleneck USD flow has a potential to jeopardize many manufacturing industry and production in Vietnam, which reduces commodity and brings up inflation. Higher than ever interest rates, boosting loan mortgage rates. Private sectors will suffer from lack of funding. Production will be halted, diminished since companies can't make enough to sustain 20 to 29% interest rates. Constant decline of the stock market index, pressure on liquidity and cash flow into the banking system. Nominal rate is all-time negative. The poor are likely most affected. The reality. Though it is not admitted by the government, many companies, factories, importers, and exporters have struggled to keep on running smoothly. In contrast, state-run groups such as Vinashin, EVN, and Petroliminax get funded from the government all the time. Still, most of them claim huge losses over and over. One of the well-known, worst-performing government-run agencies is Vinashin. The company misses its first payments of $60 million of a $600 million worth syndicated loan last December 2010 and still has not paid in full. They are going to miss the second payment due this year, 2011. The press, such as the Wall Street Journal, have run articles to cover the story. Even though the central bank is trying to set a ceiling for interest rate, it does not seem commercial banks would obey or comply with it. The official ceiling rate is 14%. Contrary to that, the OMO rate is currently at 15%. Banks' APR rise steadily to 20% to 24%. Loan mortgage interest rate is bonded between 27 to 29%. Since November 2010, the government has not been able to sell any bonds, both domestically and internationally. Auctions have always failed to find buyers. Government bonds yield 12.87% to 12.97%, among the highest in other Asian nations. The dong has been weakened over time. Dong value declined 20% in 3 years. By increasing the interest rate on the VND, the government is trying to drive people to save or invest in the dong and abandon the USD. Interest rate of the USD or other foreign currency has been cut back to 3% from 6% to 7% and is suggested to be at 1% soon. Since not many are doing so, both dong and dollar are withdrawn out of system more than they are deposited back. In speculation, Vietnamese withdraw the dong and convert it into either dollar or gold. In other words, to save their assets when facing the constant devaluation of the dong and an unstable economy. The more the government restricts on trading, depositing gold, the more people resist against it. According to an article from the Financial Times, banks in Vietnam have long been trading up gold in forms of jewelry to Sweden in exchange for foreign currency or the US dollar. They are no longer able to cope with a wave of withdrawing physical gold from depositors. Thus, starting on May 1st, banks are not allowed to accept deposit or loan gold, perhaps to prevent a gold run. Many banks tried to lure people to keep their gold behind banks' depository vaults by offering buyback programs with higher market value or secure gold free of charge and maintenance in order to have a capable gold in case of withdrawal from customers. The banking system in Vietnam is currently run to something similar to a Ponzi scheme. Newly deposited money is used to pay off interest and to avoid withdrawal. Since not many can sustain a rate of 22% or nearly 30%, business owners have to turn their back to the bank or might otherwise go bankrupt. Moreover, a large percentage of capital was used to fund non-productive sectors, for instance, real estate and stock market. The real estate market is facing a bubble phenomenon. More real estate companies are experiencing a steep decline, up to 95% in profit. Regarding the stock market, the VN index has dropped from 455 to 385, almost 18% in 5 days, from the start of it at 500 in 2000. Many foreign hedge funds' net asset values, such as the VOF and the VLF, are at a loss from 4.8% to 17%. Most foreign hedge funds operating in Vietnam are headquartered in the Cayman Islands, Samoa, and the British Virgin Islands, which are famously known as a haven for money laundering and free taxation. The picture on the left, which shows the VN index for May 26, 2011, is a strong demonstration on how distorted Vietnam's stock market is. The index aptitude changes almost 30% with 3 troughs and 3 peaks, suddenly increasing despite the absence of significant news. The second picture on the right gives a good vision of the uncertainty of Vietnam's stock market. Even though the stock market climbed almost 5% during May 26th to May 31st for no particular reason at all. Of course, none of the good news has been up during that time. Because the Vietnamese stock market is deeply manipulated by those hedge funds and government via the SCIC, a company that has the authority to buy as much stock as it desires at the cost of the government, or subtly the people, there are 2 scenarios for the stock market. The first, via SCIC, if the government decided to rescue the index, it would consume stock liberally, and thus more dung would be pumped in and trigger higher inflation, which would severely damage the economy. And second, currently there are 11.2 thousand billion dung worth of stocks in accounts of those who are unable to make payments, which now belong to the bank. Since the index has failed consecutively, stock value will also fall. And because many banks offer loans on stock, it will result in the bank's loss, less liquidity, and as a consequence, the situation may put the banking system's stability at risk. Even though Vietnam is the destination for dirty money via hedge funds, capital flights continue to occur, both in the stock market, non-productive sector, and in other productive sectors. The poor, who are officially recognized starving, yes, starving, doubled the number from last year, climbed to 1.2 million people. The number of worker protests increased 93% more than last year, taking place in 19 of the 16 provinces. None of the social improvements have been making progress. The communist regime has tried to cover up the actual number of the poor living in rural, urban, and suburban areas by lowering what is called the poor standard. Therefore, in reality, there are far more people who are living in the same situations or conditions but are not receiving the subsidized aid from the government. About 1.2 million people are those who in many forms have received something from the government. Let's not forget, in Vietnam, there are no such things as food stamps or Social Security, Medicaid, Medicare. People mostly live by themselves. In conclusion, with the current performance of the economy, it would not be a surprise if it met its end anytime soon. The capitalism-based market cannot be run parallel on the ground of centralized-based corporation without being inflicted. The ideology of such a system has never been and never will be a successful model. Of course, Vietnam is not an exception. And for those of you who barely recognize what is actually happening with Vietnam's economy right now, hopefully this video has shed some light on your perceptions.